Good morning, everybody. How you guys doing today? On this beautiful March 19th, 2025. Gonna be a good one. Hey, Erla. Hey, Better Dad. Rob, good to see you in the room. Andy Man, nice to have you. Yeah, it's FOMC, guys. What does that mean? That means the market's gonna go crazy at 2 p.m. That means a lot of the big deep pocket investors are waiting for the news. It means that the market may not follow through, that it may get caught in a range, that it may sit still. But here's the beauty of it. The market may also move beautifully and flow wonderfully, and you may find your rules met 100 times. So I try not to form an opinion on what is going to happen, because the reality is I never know what's going to happen. Like, my whole trading plan is based on the premise that I will never know what's going to happen. So I wait for my rules to be met. Good morning, Jeffrey. And I know that sounds super remedial, right? Just wait for your rules to be met. Don't worry about everything else in the world. Just go do it. Wait for your rules. And that's what we're going to do. But things that can mess up our rules, that can mess up our good time. At 10:30 a.m., it's crude oil inventories. Which means that if you are a crude oil trader, like most of you are, good morning, Izzy, good to see you in here. Then at 10:30 a.m., things may change a little bit. It may spike or jump or bump. You know when it's coming, and you can make the choice whether or not you want to be in the market when it happens, or potentially happens. At 2 p.m., it's FOMC, guys, and I've never seen an FOMC that didn't move the market. I've never seen an FOMC that didn't create spikes. I've never seen an FOMC that didn't pull you out of the perfect position and slip you $1,000. So at 2 p.m., hopefully everybody's making the decision. I'm gonna watch it. I'm gonna enjoy it. I'm gonna get a bowl of popcorn, watch the fireworks. I'm just gonna ditch out. FOMC day is always a golf day if the weather permits. So I'll be swinging clubs when this happens. You guys can let me know how it went. But every morning, forexfactory.com/calendar. Checking news, make sure I don't get on the wrong side of something. I'm a slow roll today, guys. I don't want to run out of time, or I don't want to finish too soon. Everything that I talk about, guys, and I wrote it in there, repetition, same thing, repetition, just seeing the same stuff, hearing the same thing, doing the same thing, until it becomes easy. That's what this classroom is designed for. I was talking to my brother-in-law yesterday, and he decided he wanted to be a day trader. He goes, "What should I do?" I said, "Go watch one of my videos on YouTube 50 times. Because if you pay attention, it's going to be difficult to make mistakes." And he's like, "Well, that sounds boring." It is. Making money is boring. But what you do with that money doesn't have to be. Good morning, Alexandro. So everything that I talk about comes from the Nexgen services page, specifically the trading guide. I talk about the same thing every day. Talk about a high probability trend trade. I talk about rules and advantages. And I talk about this high probability trade. Here's all the rules for it right here. If you're seeking it on your own, I talk about this trade every day because this is the trade that teaches you to read your indicators. And that's the whole goal of the classroom, is to teach you how to look at your charts and say out loud, I have what I need to take a trade because my rules are met, or I refuse to take a trade because my rules aren't met. And we're going to spend a whole hour talking about this trade that typically wins 70 to 80% of the time. We're going to spend a whole hour talking about this trade that creates confidence through the memory of success. And we're going to spend a whole hour talking about this trade that's going to teach you to read your charts. Because once you're a chart reader, you're going to realize that 90% of your day is doing nothing. 10% of your day is actively trading because your chart read told you that you are witnessing a pattern that has been proven by you to win more than it loses. That's what we're going to teach. And then once you get good at chart reading, it opens the doors for other things. You're going to understand where the market is likely to continue. No worries, Jerry. You're going to understand where the market is likely to go, and you're going to understand where the market is likely to stop. Guys, this is our first hour, every day. Our second hour is going to be clicking on the pictures that you guys post in the room. So Jerry gave me 3, and Jerry's got to leave in 20 minutes. So Jerry, I want you to get your feedback before you leave so you don't have to search for it. So let's see what we have. Big chart, saw pullbacks at fibs and run up from 67. Overnight strong downtrending market this AM. Plan to buy confirmation, gets to support or turns down from area it should not. Break even, stop initial. 2 ticks above, turn candle. Jump the fudge in trades because I sat down to trade while I saw the next plan. All right, so let's look at it. So did you have momentum where you entered the market? Absolutely you did. Did you have a clear path where you entered the market? Absolutely not. You traded directly into a Fibonacci area, and look what it did. Took you out, you tried again, it took you out, you tried again, and by the 3rd time, you were so frustrated with that area not willing to break, you said, F it, I'm just going to hold it no matter how far it goes against me. And it worked out. Sound about right, Jerry? So check this out. This line can stop the market, right? So where do you think is the best place to take a trade? Should you take a trade directly into this line, or should you take a trade from this line? Very simple language, because there is your breakout. There is your, now I'm below everything. There's my momentum style trade. And Jerry, if you could have just pumped the brakes, waited for the reaction, this is an easy win. This is a win that takes you all the way down to the next key Fibonacci area. So this is 90% of your day is being patient. Does that make sense? I love the momentum. I love the strong trending. But decisions are made at these key areas, and it becomes second nature after a while. Wait for the reaction, and then when it breaks, giddy up. I love the read. You were just a little early. You got a little bit excited. Nice job. And guys, this is what you're going to get every day. The second hour. Hey, good morning, Bob. The second hour is nothing but chart reads. So here we go again. Directly into the area. Creates a bounce. When you got back to the area, you managed aggressively because you had been hurt before. Weren't gonna risk it, and it does break for you, which I like. Then it hits the next area, creates a bounce, and then you trade right back into it. So Jerry, I love your large chart. Your large chart's telling you we're probably going down. So think about this. In below the area, out at the area. In below the area, maybe out at the area. In below the area, out at the area. You can save yourself a lot of heartache by committing to I will trade away from lines rather than in 2 lines. And again, it did break for you, which is great. There was no indication that it would, but I love it. It's the difference between a point, but it's a huge difference between look at the bounce, and let me back up. Look at the bounce, right? It's like a springboard. But once you get below it, it goes to the next bouncy point. Once you get below it, it sends to go to the next bouncy point. And it does it for you a couple times. There's so much money to be made, but the easy money is trading away from fibs and trading to fibs. And then, I'm not sure why you posted that, but good job. Keeping busy. And guys, this is what we're going to do. Jerry has to leave early, so I wanted to make sure that he got his feedback. Jerry, do you have any questions for me before you split? Does that make sense? You know where these decisions are going to be made. Now you just got to learn how to be patient, to trade away from them instead of directly into them. Let me know how it works. Your large chart reads are beautiful. You're going with the trend. You're looking for that advantage. And now you're just in that refinement process. So good stuff, man. Whatever you have going on today, I hope it's a good time. And guys, what I just did is the second half of class. But again, if you ever have to split, All you have to do is say, hey, Mark, can we do a little review before I go? And the answer is always yes. And you're welcome, Jerry. So guys, we're going to focus on this high probability trend trade. This is a trade. There's only 3 rules. Simplicity, right? Each rule gives an advantage. And it's the accumulation of 3 advantages that is the recipe for a trade. Your little equation here. A trade equals momentum. It's momentum plus a clear path plus an entry area. So 3 rules, 3 advantages, then it's time to pull the trigger. As a brand new user, this is your highest chance of success probability. Wait for all 3. Once you understand momentum and path, once you can identify it, once it sticks out and you don't hesitate, guys, you have everything you need to move beyond the high probability trend trade. But until you do, really focus your study on understanding these 2. Because Jerry's charts were a great example. Trading away from fibs rather than into fibs, it takes a lot of the stress out of trading. So we're going to focus on momentum. We're going to focus on clear path. And then your entry area is specific to trend trades. It is literally pinpointing where the market is most likely to bounce and continue in the direction of the trend. So it's only 3 rules. It's only 2 charts. I say only, maybe that's a lot for brand new users, a little overwhelming. It gets easier the easier you allow it to be. So these 2 charts, you have a large chart. This is going to define direction, momentum, and areas. And can you see where my little laser printer is? All it takes is that 1 bar. That 1 bar will define the direction of the market using the background color. This 1 bar will define the momentum using your trigger lines. That 1 bar will define the areas that are problematic using key Fibonacci areas. This large chart is a very broad stroke of a brush. It is a slow moving chart. It's difficult to see change on this chart, which makes it great because when you have the advantage of momentum and a clear path, it tends to stick around for a while. So once these rules are met, 1 and 2 happen on the large chart. Large chart always leads the way. Then you go to a smaller chart, a faster chart. This is a refinement chart. And I want you to think of it as your entry chart because that's really all you're looking for on this thing. This entry chart shows about 20 to 30 bars from the inner workings of that 1 bar. You're going to use that to pinpoint your entries, to reduce risk, to maximize profit potential. And that's where rule number 3 happens, but only after those first 2 are in play. We're using the 2 chart concept and the large and small chart for a reason because I think it's important to ask yourself, who am I trading with? Who am I trading against? Large charts, the large crowd. It's the men and women that create momentum, that establish trends, that react at key areas, right? So Jerry, every time you saw one of those bounces into a fib, that's the large crowd fighting, making decisions, and we don't have to be a part of that if we're simply trading with the large crowd. The small crowd, these are your fighters, and they still have a ton of money, and they create retracements or a pullback. Is everyone familiar with that term? It's a tiny little push that goes against everything your large chart says. We love these tiny little pushes because that's what gets us to that point where the market is most likely to continue. Small crowd typically fails 70 to 80% of the time, which means if you're following rules, if you're letting the large crowd create your momentum and establish your trend and they're not trading into an area, you can pinpoint where the small crowd's failure is to get into that market to continue with that trend. With a pattern that has been proven to win more than it loses. So we're going to take an hour. Give or take, doesn't matter. I don't have a time schedule. Ask a million questions. Make it run 3 hours. Makes me happy. But the goal initially is to learn the trigger line and Fibonacci rules for when it's okay to trade. To be able to look at those 3 rules, to be able to identify them, to know how to study them, and to learn how to believe what they mean to you in terms of advantages. Everybody in this room has a full working copy of the software. You have a platform to run it on. Whether you are day 1 demo or day 1000 owner, guys, simulate, practice, turn it into second nature, and then post your pictures in the room. That is the first step in becoming a confident trader ASAP. But don't just drop a picture and go, hey, is this good? Because remember, this is learning, right? This is kind of like 8th grade math. Show your work. Tell me why. So every trade that you post in my room, guys, I want you to do me this favor. I want you to discuss the momentum that you see. There are no right or wrong answers. I want you to discuss the path that you see. There are no right or wrong answers. And I want you to discuss your entry, where you got in, all the way to where you got out. And the reason I say there are no right or wrong answers is because you're learning to read your indicators. So it's literally what you see, whether you see a clear path or not, whether you see momentum or not. Lonnie, just take your crude oil chart and change it to YM. I don't know. I don't trade the YM. I'm very unfamiliar with the personality of it, but I did see you posting in Traders Chat, and I built a workspace, so I thought it might be fun to look at it today. But I don't know. I don't know how smooth it is. So I don't know if it's testy like the NASDAQ, if it's irrational like gold, if it's smooth like ES. But if I were going to build one, Lonnie, and sorry guys, I get confused easy. I know that I do. I would open up crude oil and I would just change CL to YM and see what it looks like. And that's exactly what I did. I set up RTY and YM because I know you guys hate to wait for trades. And you're always looking for something else to do rather than just waiting for the best. And that's okay. It turns out you're human. And if I'm not mistaken, Lonnie, you might already have one built. Have you looked at your workspaces to see if there's a Dow chart in there? John Novak may have already built one. It's not there? So are you comfortable with, go to your drop down, up here, double click on CL, delete, make CL go away, and just type in YM and hit enter, and it will, it'll change your crude oil charts to a YM chart. And then once you do that to both of your charts, go to your control center, and even though it'll say crude oil, hit save as, and you could save it as the YM. Or you could just build a new workspace, call it YM, and build 2 charts using the templates. And then in the second half of class, if you need help doing that, I got you. But we're going to get through some rules right now. But again, guys, one of the things, anytime you go to a new market, okay, awesome. Anytime you go to a new market, learn its personality, because some markets have different personalities. I forgot where I was. That's okay. That's what I love about this class, guys. My flow doesn't matter. If you have a question, drop it in there. Let's get it answered. Simulate and practice. Be willing to make mistakes. Be willing to lose trades. Learn how to move your stops. Learn how to adjust your targets if you need to. Do everything you can to break everything that's breakable, but drop the picture in the room. And guys, I'm telling you, I've broken every rule. I've made every mistake. I've lied to myself in annotations. I've lied to the room and my winnings. Nothing surprises me, and I've figured out how to fix most of it. So post in the room. The people that post the most get to where they want to be the fastest. We're going to simplify today. I try to simplify every day. I'm not nearly as smart as John Novak. So I have to simplify. I have to break it down to the lowest common denominator and do my best not to confuse myself. And I try to teach this class from that same point. Because the most aggravating word that I ever heard learning this software was it's obvious. And I don't believe that it is. I don't believe anything is obvious until you force it to be obvious. And guys, you do that through knowing what looks you're going to commit to, from learning the rules and the looks so that they become easy. Using the spreadsheet, the second piece of getting to where you want to be ASAP, guys, this is what makes it obvious. So there's 4 tabs. The first tab is is the byproduct of the sheet I'm going to give you. It's the let me learn those core advantages. Strong triggers and clear path. Because once you understand these guys, it opens doors. So you're going to start taking pictures and annotating charts and looking at strong triggers and committing that look to memory. And guys, eventually, strong triggers will be obvious and a clear path will be obvious. And it'll be so obvious that when you have both of them, you won't wait to go find your entry. But you also have to make weak triggers obvious, because this is your red flag. This is your, hey, this isn't your look. You don't have your advantage. And the same is true with termination conditions. So using the spreadsheet, this first tab, guys, I'm going to give you everything you need to study, to recognize, to get good at these reads until they are obvious. To help you with that, the client trades. You guys keep posting brilliance in my room, and I keep stealing it and creating a study guide for all the people that come behind you. Been doing this for years. The entry sequences, pinpointing precisely where the market is most likely to continue. You've got it for both long and short. Over 400 pictures of Nexgen users from posting in this room, asking for feedback. And when the feedback was, oh my gosh, this is 32 flavors of awesome, I stole it. And I dropped it in here for other people to study that pattern. There's a very pragmatic, mechanical, if-then, emotionless management plan that I'm going to give you in the written plan that I put in your hands. And then there's ideas of when you can start to manage a little differently as you grow with the software. But I think the coolest thing that happens, and my favorite thing about the software, because I love patterns, is once the basics become easy, you're going to start to see stuff. You're going to see things jumping off the page. You're going to recognize patterns that keep repeating themselves. Some of you will turn them into trades. Some of you will turn them into reasons not to trade. Some of you will just like the way they look. It's aesthetically pleasing. Whatever. Take pictures, because you're going to recognize those. And that's your chart read. And then the building your plan. This is where, when you take a great trade, when it's rules met, when it is the pattern that wins more than it loses, make sure you create a catalog of that in here so that I can wake up in the morning and this one says never miss this one in my personal trade looks. Well, what does that mean? That means that when I have momentum and the potential to break, I know exactly where my entry is. This is my pattern in a market that is standing still. This is my pattern in a market where there's no emotional attachment, there's no anxiety, there's no fear. All I need to do is learn this look and make it easy so that it slows the market down, so I know exactly where I'm entering before the market ever gets there. And that's what we're doing this morning. Fill it with pictures. And then finally is the trade tracking sheet. The trade tracking is where every trade that you take, you're going to annotate it. You're going to talk about what you saw, your advantages, your entries, your exits. You're going to drop it into this spreadsheet. And there's links to show you exactly how to do it. If you need help, let me know. But the most important section on this one is the feedback from class. Not because I'm a big deal, but because I've made every mistake you'll ever make. So you're going to post in here, and the feedback might be, hey, this is perfect. Let's do this every time. You're going to go drop it into your personal trade setups too. But the most important ones are the losers, where you may post one in here, and we'll just call it loser. I'm not going to do the whole annotation thing. And you'll look at it, you say, well, I didn't have momentum. My path really wasn't clear. And then Mark gives you lessons on how to identify the right looks and how to avoid losers, guys. And that's what I do, or unnecessary losers. I'm going to put that one in there because unnecessary suggests that the rules weren't met. And this is what we do every time. You're going to get feedback on everything. And what happens is you're going to start to see the same feedback. You're going to see perfect, and then on the next one, you're going to see perfect. And what you're doing is you're identifying these patterns that are bringing you success. Or you may see indetermination condition and indetermination condition over and over, and that's the pattern that's taking your success, guys. So if you do me the favor of posting in the room, of giving me 4 or 5 pictures and telling me why, I'm going to recognize your patterns, whether it's jumping in early or getting out late or fighting triggers or whatever, and we'll work together to fix them. So every morning, go back and study those trades. It'll take you 3 or 4 minutes while your charts load, guys. And ask yourself what worked, and ask yourself what didn't work, and what felt easy and what felt forced. In this little historical study each and every morning, guys, what it does is it sets you up for the day. You know, you're going to be like, oh my gosh, every time I had momentum and a clear path, I had no trouble finding a way to make money. But when my path wasn't clear, I lose a lot more than I win. So you'll be recognizing your patterns. It will accelerate the learning. So next 40 minutes or so, let's learn rules. If I say anything that doesn't make sense to you, I want you to raise your hand. I want you to interrupt in the middle of class and say, hey, Mark, can we do that again? Can we talk about that again? Can we look at a different example? Will you help me find clarity? The answer is always yes. Practice, 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 practice. And guys, even if you're not taking trades, take pictures. Like if you're like, oh no, I can't seem to find rules, Matt. Take the picture anyway. And say, Mark, is that a termination? Is that a termination? Are those strong triggers? Are those weak triggers? Why was that mid-band so likely to hold? Drop your questions in here, even on your chart reads, guys. It's going to be helpful. We're going to keep it simple. I will hand you a plan that has 2 trades on it. And both of those trades have checklists to maximize, to optimize your chances of success. What I give you in the first hour is not the only way to use the software. What I give you in the first hour is the highest probability way to use the software as you learn to read your indicators. So don't feel like I'm shackling you to one trade. Guys, it's not my business to tell you how to trade. It's my business to teach you to recognize the best of the best trades, and that's exactly what we're about to do. And in order to follow rules, you have to know what you're looking at. So we're going to talk about what you're going to see. These are trigger lines. Trigger lines have nothing to do with price bars. They have nothing to do with Fibonacci areas. Trigger lines are small triggers, 2 solid lines. They're a fast moving average. No matter what time frame, small triggers are always small triggers. Large triggers are 2 dashed lines. They're a slower moving average. And no matter what time frame you're looking at, large triggers are always large triggers. You know crude isn't giving you an entry at the moment because you don't have momentum or path, right, Alex? Can I call you Alex? Do you want me to go Alexandro? I was wondering that yesterday. These are the things that come into my head. Alex is cool? All right. And that's it. And Alexandro, Alex just said, man, I don't have 66% of my advantages. It's better for me to do nothing than it is to predict. And I love that. And guys, that's the hardest thing you'll ever do is absolutely nothing. Smalls, large. You're going to use them to define momentum, rule number 1. You're going to use them to define the clear path, rule number 2. You're also going to use them to define your entry, rule number 3. So guys, the only thing that you have to know about trigger lines is that these are small and these are large. These are areas. Areas will be on both charts as well. We're just naming them. And we had a great conversation yesterday that leads me to say today, don't rank them in an order of importance. Don't make one line more important than another line, guys. All of these areas are equally important. Divergence highs. This is a line that prints when there's a loss of momentum at a high pivot. Divergence lows. This is a cyan line that prints when there is a loss of momentum at a low pivot. Guys, the only way divergence is true is if that negative number prints. The negative number means nothing. It's a byproduct of the calculation. But until it prints, divergence is not true. You're going to see red lines, both charts, Fibonacci resistance. When the market's trending up, Fibonacci resistance could stop it, could create a bounce. Blue Fibonacci support does the same thing in a downtrend. It could stop the market, it could reverse it, create a bounce. You're going to see yellow 1-to-1s. Yellow 1-to-1s could create a bounce down in an uptrend or a bounce up in a downtrend. And then you're going to see the mid-band. And guys, again, you don't have to know the math that creates these, but learn the names. On the large chart, All of these horizontal lines are where the large crowd makes decisions. So they're going to define termination conditions. On a small chart, these areas inside of triggers can be the most likely point where the small crowd fails and you enter trend trades. So they have a different role depending on the chart. But the large chart leads the way. The large chart says that we must have strong trigger lines. Because when we have it, we have the advantage of momentum. So we open up our software, we look at the large chart, and you're going to notice that the background behind the first bar has a color. It's either green or red, which means the market's either going up or down. And all this is a signal for you to look for rules to be met in the direction of the trend. That's it. If it says up, I'm going up with it. If it says down, I'm going down with it because I'm not going to fight the trend. Investors have been saying for 100 years, the trend is your friend. In an uptrend, the only way to have strong triggers is if your trigger lines are green, large and small. In a downtrend, the only way to have strong triggers is if your trigger lines are red, large and small. All three have to match, background and triggers. But strong triggers is defined as when the small triggers are up and above the large triggers. Large triggers must be widening, angled in the direction of the trend, and it's the space created between the two that lets me know they're strong. Smalls are below the large are wide. It's the space created between the two that lets me know they're strong. And guys, when I have strong triggers up or down, the odds are favorable for the market to continue in the direction of the trend. Odds favorable momentum is what we call it. OFM is what you're going to see on charts all day long. Odds favorable momentum pushes a market. It's like a loaded semi just hauling down the highway. Odds favorable momentum is the look that we rely on when there's the potential to break key Fibonacci areas. Odds favorable momentum is when you guys are buying support. It looks like a tail on a large chart. You're going to refine and pinpoint where this tail is most likely to form on your small chart. But we're buying Fibonacci support with strong triggers. We're selling Fibonacci resistance with strong triggers. And guys, strong triggers, God bless it, it will cover some of the mistakes that you make as new users. As the more experienced users, you might find yourself taking a little more aggressive trades and being willing to manage because of the level of momentum that you see. Open scissors, guys, that's what it looks like. That's strong triggers. When your scissors close, when your small triggers work their way back inside of the large triggers, guys, this is weak triggers. So strong, weak. Odds favorable for the market to continue down. Anything can happen, and I want you to embrace that phrase. Anything can happen. You're going to see it on charts, ACH. Because when anything can happen, guess what? Anything happens. Key Fibonacci areas tend to hold. Retracements from the middle of nowhere happen. Bigger bounces. All these things that can mess up your good time. So brand new users, commit to the idea. Whoops, where did it go? Commit to the idea that momentum is your friend, guys. There it is right there. Strong trigger lines, breaking areas, pushing the market. And look at that, it hits Fibonacci resistance with a little bit of weakness and it retraces. Creates strong triggers. There's one of those tails. Might have been an entry. And then it weakens and a bigger retracement. And then it's weakened and a bigger retracement. Pretty cool, right? Strength pushes, weakness. Look at the market pulling down. Is everybody good with that? Can you give me a why? Strength versus weakness. Know the difference. One of them is amazing. The other one turns it into a crapshoot. Once you have strength, we're going to make sure there's nothing in the way. Once you have strength, we're going to make sure that there's no termination conditions. Horizontal lines on a large chart, that's a termination condition. When there's none present, you're going to have room to your profit targets. We're just going to call it a clear path. Hell, you could annotate it CP on your chart. The termination condition is just that horizontal line. It's that area on a large chart. And blue Fibonacci support, red Fibonacci resistance, yellow 1-to-1s, divergence highs and lows. And these are all equal. None is more important than the other. None is more likely to hold than another. None is more likely to create a bounce than another. Just know that a horizontal line on the large chart is precisely where the large crowd is most likely to make decisions. So to identify a termination condition, you've got to let the large chart or the large crowd get there. You've got to let price reach an area. So that's the first step in identifying a termination condition. Price reaches Fibonacci resistance. It could be a divergence high. It could be yellow 1-to-1s. They're all the same. Price reaches Fibonacci support, a divergence low, yellow 1-to-1s. They're all the same. And then once price gets there, the decision-making process goes into motion. We're done with price. Now you're going to look at your trigger lines, and your trigger lines are going to tell the story. If your triggers remain below resistance, resistance is a termination condition. Resistance could create an untradeable bounce. Resistance could set off a fight between buyers and sellers that you don't want to be a part of. Resistance could break and go to the next level. And resistance could reverse the market completely. And if it does that, large triggers go from green to red. We call this a strong top. And I mention a strong top not because it's a rule for the high probability trend trade, but because when you have a strong top, the next high probability trend trade short is the highest probability trend trade short. When you have a strong top, it sets you up for the second trade that we're going to talk about this afternoon. When you have a strong top, it is rule number 1 for HVA trades. If you add that market flow chart, it is rule number 1 for a Nexgen momentum trade. Good things happen after strong tops. And then if the market is screaming down, price reaches Fibonacci support. We're done with price. Where are my triggers? Say it out loud, guys. Your dog should have a Pavlovian response to where are my triggers. Maybe give it a treat every time. If they remain above, it's a termination condition. It could create a bounce. It could break. There could be a fight. It could reverse the market and become a strong bottom. And here's the gospel truth is I'll never know what the reaction will be. I'll never know. Nobody's ever going to tell me. Nobody's going to ever send me a fax or smoke signals, call me on my BlackBerry and say, hey, guess what, Mark? When we reach Fibonacci support, we've decided that we're going to reverse the market. So whatever you do, don't trade into that area, right? You don't get that. But what you do have is a solid rule that says don't trade into that area. Because more often than not, this area is going to stop the market and ruin your good time. Not every time. It can break. But more often than not, and that's how the rule came to be, if price reaches Fibonacci resistance and the triggers don't break, don't take that long trade. Alexandro said, there's nothing for me to do, and that's exactly where the market was trading when he said that. Right to resistance, over to support. Came straight from resistance, right from support. That giant downtrend, where did it start? On a pullback to resistance, and down it goes. And that uptrend, right from a divergence low. So guys, rule number 2 is designed to keep you safe. Rule number 2 is designed to keep you from trading into areas that may stop the market. That's why Jerry and I talked. It's easier to just get to the other side. So if it's going to break, if it's really going to break, the triggers will tell the story. Every line you reach will be a termination condition, at least for a second, guys. So price reaches Fibonacci resistance. This is the number 1 here. The triggers are still below, and this is a termination condition. Your highest chance of consistent success comes from doing absolutely nothing and waiting for the reaction. It's not until both the small, both lines, and the large, both lines, get above resistance that we will consider resistance broken. It's not the price bars. It's the trigger lines. Once price reaches resistance, we're done with price. It's all about triggers. So your 2 options, brand new users, give me 5 days to figure out the difference between a termination condition and a clear path. Go study it in your spreadsheet. Know the difference between a termination condition and a clear path. Because once you can tell the difference between the 2, it sets you up for the second trade. And the second trade relies on momentum, that lesson from rule number 1. And when your small triggers smash through the area, 3 or 4 points, don't let them prairie dog, guys. Make them get through that area. But your large triggers are lagging behind. They haven't quite made it above, so the path isn't clear. This look with all that momentum lets me know that area has the potential to break. And you can trade that potential. And guys, I'm telling you right now, most of your trades will be this look. But because you're sacrificing the clear path, you have to insist on momentum. Why would you give up that advantage as well? You need to have a very clear low risk entry, because why are you going to give up the entry advantage as well? And you'll do that. You'll take these. You'll manage them. This will be the majority of them, whether it's a long trade or a short trade. First, it's a termination, do nothing. Then it has the potential. Then finally, it's a clear path. And guys, your clear path stays in play until you reach the next line. This clear path was a clear path until it reached this line. And look at the bounce. That's that reaction at a key area. And then the path isn't clear, and sure enough, everything's heading down. You've got momentum, and you have the potential to break 66.80. You'll notice a lot that when support breaks, it behaves as resistance. Breaks behaves as resistance. Breaks behaves as resistance. Breaks behaves as resistance. Joel in the room took that short yesterday. It was beautiful. Pretty cool, right? You guys know exactly where the large crowd is most likely to react. Takes a lot of the guesswork, a lot of the hope out. You're in the trade now. So Alexandra, I want you to do me a favor. I want you to avoid the temptation of talking about what you're doing. Show me what you're doing. Because my rules say that when I reach a mid-band and the large triggers are above it, my mid-band is a termination, and price is more likely to suck back to those large triggers than it is to continue down. I don't have rule number 2 met. And it means that I might put bad juju on your trade and make you think about things that you don't want to do. But I see why you did what you did. We'll see what happens. Have a great day. There's going to be times, ladies and gentlemen, there's going to be times when your path isn't clear. There's going to be times when the areas are stacked. And this is 90% of your day. You can still take a picture, though. Did you guys know that you can scroll back and take pictures 10 days back? There's no excuse to never take a picture. Even if you have to take it down, write a note. At 9:41, I took a short trade. Let me make sure I go back and annotate it. Yeah, no worries. Guys, support, support, support. This is 90% of your day doing nothing. Not trading into areas, not trading without momentum, not trading when you don't have the perfectly defined entry. But it's okay, because the futures markets trade billions hourly. The futures markets trade trillions a day. They exchange trillions each and every day. If you can make $400 trading from a fib to a fib, you're in a 6-figure income with your trading. And trust me, that potential's there. If you don't see it yet, you have to let me know, because we're going to go find it together. So is everybody good? Price reaches an area. Whoops, that's the wrong chart. Price reaches an area, no triggers through, sit on your hands. That's your highest chance of success. Small triggers through is only potential. And you can see the potential failed here. No triggers through, perfect termination. Large chart tells the story, guys. Large chart tells the story. I'm going to assume you guys are good with it. Your silence I'm going to take as a yes. Guys, when the large chart has momentum, when the large chart has no termination conditions, there is one time on a smaller, faster chart that I'll refuse entry because it behaves as a termination condition. This is the only termination condition on a small chart, guys, and that is 3 divergences in the same price range. You're not going to see the change coming on the large chart. but your small chart will give a heads up. If you see 3 losses of momentum from a low or a high, know that it's a termination condition. So no short trades into a termination condition if you're following rules. But this is a good one because if you took the short trade in 3 divergences print, it becomes an awesome opportunity for you to manage out of that trade either with a smaller or no loss before it realizes the potential to push up higher. So that's the only time, if my rules are met on a large chart, the small chart talks me out of it. Are you guys ready to go define entries? Yay! Sorry guys, I'm in a silly mood today. Entry, small chart. Entry is on the tiny chart, the fast chart, the refinement chart. We're going to take the inner workings of that one bar that established your momentum and clear path, and we're going to refine it down to the point where that small crowd is most likely to fail. And you're going to do it with such accuracy that you're going to use a limit order to buy or sell that pullback that they create, and you're going to have that limit order waiting at an area, at a fib, at a midband, at a yellow 1-to-1. Because the same way those lines on a large chart can stop forward progress and mess up your good time, on a small chart, they can stop the small crowd's forward progress and mess up their good time, which means that when we enter in an area, specifically inside of triggers, we're getting in right where the small crowd is most likely to fail and right where the trend is most likely to bounce and continue. Triggers are a big part of that entry equation because triggers will define where the retracement, where the push, where the pullback is most likely to go. Price returns to the triggers on the large chart. Price returns to the triggers on the small chart. It happens all the time. That's why this midband is a termination condition. Because when price accelerates away, it's notorious for closing the gap to the triggers, just like it did here. Just like it did here, and just like it did here. So on your entry chart, you're going to have 2 sets of large triggers. You're going to have both the 5-1 and the 13-2, and they're going to work together to define the retracement zone. That's it. I know that push may go from somewhere at the top of these triggers to the bottom of these triggers. That's it. It's just a retracement zone. It has nothing to do with the entry. But if you allow them to be what we call favorable large triggers, if you let the large and the synthetic, the ones from the 5-1 and the 13-2 overlap like 2 snakes riding piggyback, you have the smallest little area where the retracement's most likely to occur. When you put a fib or a midband or a 1-to-1 inside of that retracement zone, you give the market something to bounce off of. This is how rule number 3 provides precision. This is how rule number 3 reduces risk. And this is how rule number 3 increases profit potential. So we're going to go through and we are going to use a limit order to buy or sell a pullback at an area inside of triggers, guys. And that's going to be the language that you're going to embrace until it becomes second nature. So once the rules are met on the large chart, I'm going to turn my attention to the small chart to find my entry. So in this case, large chart is up. Large chart has odds favorable momentum. Large chart has no termination conditions. I'm going to go over here and wait for the small crowd to do their thing, guys. So I'm waiting for a reversal bar. You're going to learn how to squash the fear of missing out as this market goes up and understand that this is the pattern that repeats itself often. The reversal bar is not your entry. The reversal bar signals the beginning of the pullback. And once it prints, or really even before it prints, because you're going to start calling your shots, you're going to look over at the trigger lines, large and synthetic, and you're going to say to yourself, price may retrace from the top line to the bottom line of those triggers. And the tighter they are on top of one another, the smaller that range becomes. So the white box defines where the retracement is most likely to go. But I need areas, guys. I need an area inside of triggers. Trigger lines aren't bouncy. Fibs, midbands, yellow 1-to-1s, those are bouncy. It's like throwing a tennis ball up against a brick wall, guys, when they're inside of the retracement zone. So this much smaller, more concise box shows precisely where the market is most likely to bounce to continue with the uptrend, where the market is most likely to bounce, where the small crowd is most likely to fail. And if you go back and do a little bit of study, participate in my room, learn this look, you'll have zero hesitation activating a limit order a couple ticks above that highest point of support, because that's the one. It could bounce off of this blue fib, but I want to make sure I'm in that trade. I'm going to catch the small crowd on their way down, knowing that this is where they're most likely to bounce. And if the small crowd gets there, guys, if the market gets there, you've done all you can do. You have the advantage of a market that's likely to continue up because of strong triggers, and there's nothing in the way to create a bounce because there's no termination conditions. You have entered where the market is most likely to continue in the direction of the trend. This is your high probability trend trade entry, guys, and this is all we've talked about so far, is the high probability trend trade entry. And that one's not giving it. I'm not sure what the market's doing. Here we go. I mentioned those tails, right? So I want you to see just right here, with all of that momentum and the potential to break that divergence high, the market pulls right back to support, right inside of the retracement zone. And sure enough, it continues up all the way to Fibonacci resistance. Do you guys see this? This is your pattern. They didn't get you on the first one, maybe. They came back for you. They do that a lot. So you can scroll back on a large chart. Let's see if we can find some rules met. Odds favorable momentum, potential to break. I'm going to go back and take a look. What does that circle look like? Whoops, oh, blew right past it. There it is. Pulled right back to support inside of triggers. It had the potential to break, right, Better Dad? Cool. So Better Dad, you're saying that's not your trade, right? Because it's only the potential. It's not a clear path. Because you're a brand new user. That's no worries. But Better Dad, is the pattern true? With all of this momentum and the potential to break, did the market pull back to support inside of triggers? Hell yeah, it did. With all of this momentum and the potential to break, did price pull back to triggers? Yes, it did. So Better Dad, this is your pattern. Now, whether or not you're in a position to take it, whether or not you're comfortable with the divergence, that's going to be on you. But the pattern is consistent, guys. So you've got to lock it into your brain that when everything is met on the large chart, reversal bar, define the retracement, look for the areas, the window where the market is most likely to continue, activate your limit order 2 ticks above it. Reversal bar starts to pull back, define where it's most likely to go, define where it's most likely to bounce. This is where the market is most likely to continue. And the pattern's the same. Whether it is a high probability trend trade, whether it is a medium probability trade, it's a pullback to areas inside of favorable large triggers. And Better Dad was absolutely right. Sometimes it's a clear path. Sometimes it's only the potential. But all we're doing right now is we're defining where the market is most likely to bounce and continue. And once you define where the market is most likely to bounce and continue, you understand where the market should not go by default. The market should not push beyond those trigger lines if this is going to be a winner. The market should not push beyond those areas inside of triggers if this is going to be a winner, which means that your initial stop goes 4 to 5 ticks above those trigger lines where the market should not go. By defining where the market is most likely to continue, you've set yourself up for the first step of management. So we're just learning the patterns. With momentum and clear path, entries come from the areas inside of triggers. Can you guys give me a why? Why do I talk about the tails? Remember when we circle the tails? If they line up with areas in the retracement zone, guys, this is your pattern. There's a million variations. There are a million variations to enter this trade. We're talking about the best of the best, and that means clear path and all the momentum. And we're not worried about these one-to-ones because terminations happen over here. And we're not worried about the triggers coming against us because momentum is established over here. Your small chart is designed to get you in at the best of the best. That's what the high probability trend trade is for. That's why we study it. That's why I go over the same thing every day to make sure that you can enter the market with the highest advantage. So this is where I give you everything you need, guys, and it starts with Chart Reading 101. And Lonnie, if you need to split, let me know. Chart Reading 101. Guys, the goal is that you are committed to that large chart, committed to those first two advantage. You are hell-bent on forcing the market to give you momentum and path. This is going to make it so it's easy to recognize. This is the repetition, guys. This is the recognition. So take 25 pictures each and take the time to explain on the picture you took why it is a strong trigger. What is the look? What does it mean to you? What rule does it pertain to? You're going to take these pictures, strong triggers, weak triggers, clear path, termination. I said the other day, if 100 pictures feels overwhelming, take 5 a day. That's cool, whatever. It took me about 4 hours to do all of this, guys. But the idea is that you can't take a picture of strong triggers. You can't write separation. You can't say it's rule 1 met. You can't do that 25 times and mess up the look. It's the same every time. It's just a pattern. You can't look at weak triggers and define it and mess it up. If you do that 25 times, guys, this little exercise is designed to make you a chart reader. So take them, put them in there. If you're not sure about them, use this next document, the High Probability Trend Trade Checklist. This is the best of the best, highest probability way to get into a high probability trend trade. It starts with a strong top or bottom. It's not mandatory. It doesn't have to be there. But when I have a strong top, my high probability trend trade short is just a little more likely to win. When I have a strong bottom, my high probability trend trade long is just a little more likely to win. Know the language. It is a strong top or bottom that no triggers through, termination that reverses the market. First it's a termination. It's always a termination. Then it reverses and becomes a strong top. Momentum is always momentum. Weakness is always weakness, guys. Let it be black or white. A termination always says no trades into the area. The potential says manage assertively. The clear path remains a clear path until the next line is reached. Make sure you know the difference between the three. Understand how to pinpoint your entry, exactly where your order goes, and exactly where the market shouldn't go, because that's going to be part of your management plan. So the second page of this one, this is your high probability trend trade checklist. This is the best of the best. This is the checklist that nobody has ever been able to truthfully mark yes to all of these and do worse than 70%. This is the same checklist you're going to get on the plan I'm about to give you. The KISS plan. Guys, this is designed to optimize your chances of success with the high probability trend trade as you learn to read your indicators. This is a stepping stone in your learning journey. This is your first trade that's going to teach you to see the other trades. And there are 2 things that you have to know before you sit down to trade and you're not on sim. You need to know why you will enter a trade. How's this for the Sunday school answer? I will enter a trade because my rules are met. Because my rules describe a pattern that has been proven to win more than it loses. And I've gone back and I've studied it, and I've verified it, and I've validated it, and I'm learning to trust it over time and repetition. And there's no reason to not consistently enter when your rules are true. I no longer put my advantages in there or put my opinions in there. It's simply advantages. And guys, your rules are going to help remove the emotions of trading. You'll never know what's going to happen next. But if you're trading the same pattern repeatedly, you know that it's been proven to win more than it loses. That takes a lot of fear out of trading. It also puts a lot of confidence in stop placement because you know where they shouldn't go. And then you have to know why you'll exit. And Better Dad, I have a feeling this is funny. You have to know why you'll exit a trade, guys. Either it hits your profit target or you lose your advantages. That's it. So if I enter a high probability trend trade and it goes 4 to 5 ticks beyond my trigger lines, I've lost the advantage of rule number 3. I'll choose to exit the trade. If I get into a high probability trend trade and 3 divergences print in the same price range on my small chart, I've lost the advantage of my clear path. I will exit the trade. Guys, management, you'll find, is the most difficult part because management wraps its nasty little arms around your emotional strings and forces you to sit in a market despite your opinion. It forces you to exit a position despite your hope. So in the beginning, let management be just as mechanical as entries. If then, if then, if then. So your management plan is based on 2 contracts. And the KISS management is designed to help you understand where to put your stops so that they're based on logic and not emotion. And it's designed to get you paid, guys. TTFM. You're going to hear that in the room a lot. TTFM. Most of you can figure out what that means. Oh, but the bot came in and told you. So 2 contracts, guys, and your plan is designed. It revolves around your ability to enter where the market is most likely to continue. So if my entry is 2 ticks below resistance inside of triggers, that's a short trade, then my initial stop is 4 to 5 ticks beyond the triggers. That's it. That's the beginning. There's nothing else to do. Put your hands in the air. Roll back. This is where the market should not go. And you'll know your risk before you ever enter the trade. You'll know what you're up against. You knew that this was $150 worth of risk before the entry was ever taken. If you're not okay with $150 of risk, you need to not take the trade, right? Because if you put your stop below resistance inside of triggers, it's likely to get hit. The odds are favorable. If you put it in the retracement zone, the potential for it to get hit and then the market to go down without you is there. So on simulator, you're developing the courage to put the stop where the market shouldn't go and then just say, they're going to have to come get me if they want my money. More often than not, if the rules are met, they're not going to come get your money. They're going to give you what we call a reversal bar or a confirmation bar. And this down bar says, hey, guess what? Lonnie, we're going in the direction of the trend and the momentum and the clear path. We're confirming movement in the direction of your trade. And guys, this is where you're going to redefine where the market should not go. You're going to say they're doing everything I hope they would do. I'm going to put my new stop 2 ticks above that reversal bar. And you just went from $150 per contract to $30 per contract with a very mechanical if-then scenario. It doesn't mean that you're going to win, but it means that if you lose, you don't lose a lot. But again, with all those advantages, it's more likely to go to your first target. Your targets are predetermined, $100 and $200. Resist the urge to move them. And guys, if price reaches your first target, 1 contract is automatically removed. Those funds go into your account. You're a winner. That's success. It breeds confidence. And there are children singing stories about you in the streets. And with 1 contract remaining, you're going to move your stop to break even. 4 to 5 ticks, Lonnie. 4 to 5 ticks. Because we're good. We really are. The precision is overwhelming. But the market could go a tick or 2, and it's just a little overrun. So 4 to 5 ticks, it shouldn't go here if this is going to be a winner. It shouldn't bounce back up above that if it's going to continue in the direction of the trend. And then once $100 is made, I'm going to go break even. And break even's not my best stop, guys. I'm going to tell you right now, but you will create your own management plan based on your ability to reading the indicators. Now you have no risk on a trade and profits have been taken, and it's going to give you the courage to remember that the only reason you took the trade was because the large chart had odds favorable momentum and not a darn thing in the way. And it's more likely to go to your second target than it is to bounce up and get you out break even. And man, if it goes to your second target, it's a $300 trade. But it's not a $300 day, right? That's 4 minutes of your life, ladies and gentlemen. 4 minutes of your life. That's a $300 trade. Let's say you shut down every day at $300. That's a $75,000 year. Let's say you find an extra $100 in there somewhere. Now you're in six figures. The futures markets trade trillions every day. You have to find a way to conservatively, consistently capture $400 to $500 a day, and you will never work again. And then Better Dad has already figured out how to beat the system. Take that same $300 a day, mirror it on 5 accounts. Multiply that by 252 trading days. It's the same $300 trade. And now you're a part of the 1%. And guys, that's the goal. The goal is consistency. The goal is doing the same thing every time because it's been proven to win more than it loses. So in the room, there's the all you need zip. Everything that I just talked about, including the PowerPoint that I used to teach. In the room, there's the trade tracking sheet. Every place you need to learn the basics, to create a plan, to study these looks. The only thing Nexgen doesn't give you is experience. If we find out how to do that, the software price is going up. You have everything you need. You know what you're looking for, where to look for it, how to study it, and you get feedback 15 hours every week, making sure that your chart reads are accurate, that you are identifying the patterns, guys. The only thing you need to do now is repeat, repeat, repeat. Do the same damn thing. Take the same darn trade. Recognize the same darn pattern and convince yourself, prove to yourself, try to prove me wrong that this is in fact a trade that wins more than it loses, and never hesitate. And guys, through simulation, study, class feedback, and continuous practice, you're going to open the doors for the second trade, the potential to break trade. And I'm giving you this plan, and guys, I'm giving you a set of rules that have been proven that optimizes the best of the best, not the only, the best of the best way to take that potential to break, that 50-50 trade. And it demands that you come from a strong top or bottom. Because when you don't, these fail more often than they don't. You have to have momentum on both charts. Because if you don't, it's not even the potential to break. You can't have divergence on your entry chart. Because divergence is a loss of momentum, and we've already sacrificed a clear path. But if it's all yes, use the entry rules. Enter an area inside of triggers. And it reminds you, divergence kills these. And it reminds you in management, divergence kills these. So guys, if you can't identify a strong top or bottom, you're less likely to find success with the second trade. If you can't identify momentum, you're less likely to have success with the second trade. If you don't know the difference between a termination condition and a 50-50 look, you're going to struggle. If you can't identify divergence, you're going to struggle. So keep it very simple. Focus on the basics and understand that it's going to take you anywhere you want to go with the software. So that's my first hour. How do we do? You guys feel good about it? ES is railing up, isn't it? Uh-oh, that's my untitled. The cool thing is these are patterns that happen on all sorts of time frames. Hey, Alex, price closed the gap to the triggers, didn't it? Isn't that crazy? With a little bit of study, you'll know that that's the most likely scenario, which will keep you from hoping it goes down from here. Does that make sense? Guys, this is one of the patterns. This is what we call the gap theory. And the gap theory just crashed my NinjaTrader. Stupid gap theory. But that's the premise that price returns to the large triggers. Price always returns to the large triggers. I've never seen price not return to the large triggers. So when the large triggers are a full bar away on your large chart and it hits something, your job is to sit still, to be a little patient. And Alexandra, what a great lesson, right? Because now next time you go to take that trade, you're going to go, wait a minute, we reached the mid band. Where are my large triggers? And that's what we call avoidable losses. Isn't that amazing? All it is patterns, guys. Avoidable losses. Sitting still when there's nothing to do. I'm going to disappear for 5 minutes. Lonnie, do you need feedback before you head to work? Just want to make sure. Gap theory. If price reaches a mid-band, Lonnie, if price reaches Fibonacci support, if price reaches yellow 1-to-1s and the large triggers are a full bar away, if they're above that reversal bar marker, that's the gap theory. Price is more likely to close the gap back to those triggers. And look at this. Mid-band and fib closes the gap back to the large triggers. Hits the fib, closes the gap. I bet we'll find another one. Mid-band and fib closes the gap. So the gap theory, Lonnie, you're going to see about 50 pictures of it in patterns that repeat themselves. You're going to see that same look in the termination conditions, because what it's saying is, hey, your advantage is gone. This is the most likely pattern. Pump the brakes, let it play out, and then look for your opportunity. So Alex, if it's killing you watching without your rules met, do what I'm about to do. Go take 5 minutes and just run a lap, guys. The longer you stare at a market that isn't giving you your rules met, the more likely you are to break your rules. So trust me on this one. That's from experience. I'm going to go stretch my legs. I'll be back in 5. When I come back, we're going to look at all the charts that you guys post. I am fully aware that the market isn't playing the way the market typically plays because it's FOMC day. If we need to call it an early day, we will. I'm going to open up the YM. I know some of you guys are trying to find that YM. I'm going to open up RTY, and we're not going to go through and try and figure out the personality. We're going to go back on these charts, and we're going to circle tails when rules are met, and we're going to see if the patterns repeat themselves on different markets. So there's your YM, and it has absolutely nothing to do. Termination, that's a termination. This is a termination. You guys can watch it play out, though. I'll be back in 5. Who got faked out? Who said, yes, finally, finally, it's breaking out, it's going to drop, I'm going to make all the money in the world, and then chose to ignore that they went right into the termination condition? Guys, that's how it works. It's not what you want to have happen. It's whether or not your rules are met. Let it be that simple. So I'm going to scroll up to the very top of the classroom, guys. We're going to look at some stuff. And I want to remind you guys that everything that I do is gauged on reading indicators. Everything I do is reading what you wrote to make sure that it's accurate. Everything that I do is designed to give you feedback to get better at what you're doing, to give you something to help move forward. And I look at what you write on charts. I do. I pay attention to it because I think it's important to be very honest in your annotation. So remember as well that one-time instances don't define patterns. So if you make a mistake once and I point it out, it doesn't mean you're a horrible person and that's your thing, right? It means that, hey, this is just something that I want to avoid. This is something that I want to work on, that I want to be focused on. So Bob says, check it out. Weak bottom, none of the triggers it's not a termination, it's kind of in the middle of nowhere. And then it reverses and gives them the best momentum ever. And Bob says, check it out, Mark, 50-50. The smalls are above, large are below. He defines it. He knows that because it's 50-50, it's only potential to break. It hasn't broken yet. So price pulls back, reaches support, right at triggers. And this is why I mention annotation honesty, guys. Entry area got in on the reversal bar. And let me make this a little bigger. And it was funny, Bob, because this was so me. The market started coming down, and then it started going back up. And Bob said, oh shit, it's going without me. Pardon my French. But he knew that if he got in on a reversal bar, well, then it makes sense. He waited for confirmation, but he didn't. The reversal bar printed 2 bars later. Do you guys see that? You will feed yourself what you wished you had done. You'll feed yourself what you intended. And you know, the honest one would be, I anticipated a reversal bar, but then it came right back to the area inside of triggers, and dang it, it cost me 2.5 points of risk. And then this would have been a great entry. That would have been a great entry. This reversal bar would have been a great entry. Any of these work, right? But Bob, and let me go back because I celebrate victories. Bob says with this look, with this momentum, with these areas inside of triggers, my anticipated outcome, the most likely outcome, is that momentum carries it to the next key Fibonacci area, that the buyers are looking for that next area. And look what he does. He gets paid almost there, and then he gets paid just below it. And Bob, it is a gorgeous trade. And because you understand where the market shouldn't go, you stayed in it. It was no big deal. And now next time you look at this trade and you see this pattern, Bob, you're going to say, don't anticipate the reversal bar. Make it give me the reversal bar, because that reversal bar establishes your risk when you use it. So great picture, Bob. All right, and then this is a great one too. And I love this picture because lesson time, what not to do with a 50-50. This is a good one. I think this picture illustrates the importance of feedback. So we're going to go through it. Bob says 50-50, rules not met, tried it anyway, got lucky, low probability, egads, little fishes, death and destruction. What am I doing, right? So let's go through it. And here's our checklist from the KISS plan for 50-50s. I've done it. I can't stress enough. You guys can't do anything I haven't already done. So on the 50-50, from a strong top or bottom, Bob says, hell no, Mark, that's a weak top. To which I say, Bob, price reached a divergence high. Price reached a divergence high. None of the triggers broke. And it reversed the market. This is a strong top. And now rule number 1 is met. Does that make sense? Hey, Lonnie, check this out. Go to your spreadsheet. Go to client trades. And there's about 20 annotated pictures, 25 annotated pictures of the gap theory. When I'm done going through pictures, we'll go back and do another one. But we'll find it live in the market, or at least what's happened today. All right, so back to work. Because Bob was willing to post, because Bob was willing to annotate what he was reading, we caught a correction, and now he's one step better to this trade. And then, let's see. Bob says, well, I had divergence. And Bob, I'm not sure what about that. Bob's brain said, divergence. He's looking for a reason for things to be wrong. That's just a reversal bar, right? That's just a little fight. Divergence means that there's a negative number in a cyan line. So no divergence on the 5-1. Bob said, damn it. I can't take this trade without breaking my rules. But the truth is that there were very strong triggers, both charts. There was no divergence. And there was a perfect pullback to areas inside of triggers. And what Bob realized, because he has the courage to post even when he thinks he made a mistake, is that Bob didn't make a mistake at all. Bob took the perfect entry on the best of the best look that it could ever be. Yay, Bob, right? So now Bob knows that that's not divergence. Now Bob knows that this is a strong top. And then Bob, I said that if you were following KISS plan management, this divergence from 64 is a deal breaker, right? That's an exit condition. But Bob, you can also say, and remember, that's just the best of the best. Bob, at 64, you had a clear path, didn't you? The market bounced off 64. I want you to see this. At 64, you had a clear path. No, you didn't. Not quite. Sorry. Not quite. That divergence wouldn't scare me out a bit, Bob. And that's maybe a little more advanced. So, great pictures, beautiful annotation, and some really awesome lessons to go with that. And Lonnie. Looking for a textbook example for you, my friend. If price accelerates away from the large triggers and hits an area, price is more likely to return to the triggers than it is to continue down. And that's it. That's the whole gap theory, and that's all it is. And it's just a patience piece. It's a hey, wait a minute. Roy, you can't. Roy, you can have me for a private meeting by posting a picture in the room, and I will ignore everybody in the room except you. That's your private sessions. Because, Roy, please don't take this the wrong way. I've probably done 50 private sessions, and everyone believes that I'm going to tell them something that I don't tell them in the room. And nobody shows up prepared, and nobody brings me pictures, and nobody has a trading plan. They think that by being on the phone with me for 30 minutes, it's gonna fix them, and it doesn't. Roy, post in the room, post in the room, post in the room, post in the room. Trust me on this one. I have blown out Saturdays, I've blown out my evenings. The recipe's the same. Have momentum with nothing in the way, and buy a pullback to an area. Sell a pullback to an area. If price reaches an area and the large triggers are a full bar away, no shorts. Let it close the gap. It really is. Every time you post a picture, guys, it's a private session. Every time you post in my room, I don't care about anybody else in the room. The only thing I'm concerned about is your chart read, what you're looking at, what you're reading, what you're doing, what you're thinking. And I will give you my wholehearted 2 cents on it. High probability trend trade, odds favorable, large and small got below, pull back to resistance inside of triggers, easy $300, easy, easy. Wayne, this is gorgeous. What a great trade. Odds favorable, both sets of triggers below trouble, price hasn't reached trouble, pull back to an area of resistance inside of triggers, $100, $200. That's a $300 trade, ladies and gentlemen. And that took Wayne a minute and a half. There is nothing I can make up to make that a better trade. There's nothing I can tell you to make that a higher probability. Yeah, in the room, Roy, right here. Have you posted a picture? You've posted picture for feedbacks, right? I've seen you post pictures. So Roy, if you had me in a private meeting on Skype, right, or on Zoom or Teams or whatever, you would still have to show me pictures. And you would still get the exact same feedback that you get here in the room. I don't hold back on you guys. I give you everything in my arsenal right here. Awesome. I love it, and it's such a common question that I wanted to address it so that everybody could get the answer. Andy, large chart, momentum and path, small chart, pull back to resistance, paid twice at trouble. Absolutely perfect, Andy. Trading the NASDAQ, riding the lightning, enjoying the adrenaline. And then Wayne, odds favorable, potential to break. Lonnie, that's on the 13-2. So where are termination conditions defined, right? Always the large chart. Always the large chart. I love it. Good stuff. And then let's take a look at this one. So it's a 50-50, barely. There's no divergence. Wayne, your retracement range is huge. You decide to get in at the mid-band. You know where your stop goes. And you get paid at trouble, and I love that. Taking a medium probability scenario and being willing to get paid at trouble instead of hoping for a home run. Really nicely done. And Roy, I hope that didn't sound ugly, man. I hope that didn't sound like I don't want to help you, because I do want to help you. I want to help everybody. I just want to help you in the right arena. All right, we already saw Jerry's, so better dad. Let's see what you did, my friend. Strong bottom? This is the weird one. This is the weird one, better dad. Because it started to print a fib and then it stopped printing the fib. And I don't know why it did that. So let's say maybe. I guess I'm going to say yes. Because clearly that stopped right at a key number and reversed. You had the best momentum ever. The path is as clear as it could ever be. You do get in 2 ticks above the mid-band. The challenge on this one, huge risk on this particular trade. But once it starts to go up, you can reduce risk, and then it just flies, and you take it until there's a reversal bar. Absolutely beautiful trade, better dad. Nicely done. There we go. That's like the strongest top ever. Not only is it a termination at a fib, it's a termination at a 1-to-1, it's a termination at a divergence high. I mean, holy smokes. And then you get the reversal, and then you get momentum. And then you get a clear path. Oh, let's look at that entry. Missed that one annotating. That's okay. 1475. So you're in 2 ticks below. Good where the market shouldn't go because you know that it may return. Guys, this is such a great lesson. And Better Dad, you've done this amazing. You understand where the market shouldn't go and you're willing to put your stop there because with this look, it's more likely to go down than up. And I think that you're killing it here. And you may be on break. We may have to come back to these. And then there's $100 and there's $200. All it is following the rules. All it is that darn pattern. Have momentum and path. You'll be amazed at what you pull off. Great job. How are we doing so far? I'm going to skip Better Dad's other one. Roy, let's see what you did, my friend. This is my why. I love it. It was a strong bottom. I can't tell, but it doesn't look like it was, but that's okay. I waited to pull back. It did at fib and break it and turn to support. It wasn't too clear, but the trigger was strong. So I saw it was going to break. I entered to hit my first target. I saw it was pulling back. So you closed it. All right. So everything was strong up, right? Momentum, screaming. So why did it pull back, do you think? This is a good lesson. Guys, what do you suppose caused that big bounce? Does anybody have an idea? What made the market spike all the way back to support inside of triggers? Termination condition, right? For sure, we can see it. And then Roy said, I'm not going to trade directly into a termination condition. I'm at least going to enter above the problem. And I'll trade to the next problem. Does that sound about right, Roy? If you wanted to take a risk into the fib, that was your low risk spot. But because you didn't want to trade into it, you said, let me get to the other side of trouble. Let me get out of trouble. This is nice, Roy, because you have momentum on your side, and instead of hoping an area breaks, you give it the chance. You say, I'm cool doing nothing right here. It might work, but it's less likely to. Let me get to the other side, and I know exactly where the market may stop. There is no pullback on your trade. You're just jumping in. So you're relying on that momentum to carry you to the next level, and it did. Sound about right? Awesome. That's what I would have told you on the phone as well. Let's identify the challenge. Let's celebrate the beauty of it. And know that there might be a day where you try to take it here and get out right there at trouble. And now you already know how to re-enter when you're done with trouble. So I love everything about that trade. I like the patience because that's hard to do. It is so hard to feel like the market's going to go up and not want to just jump in and go up with it. Beautiful, beautiful job, Roy. Where am I? Morgan. Let's see what Morgan thinks. Morgan says, Mark, I want you to check this out. We're coming from a strong bottom. How do I know that? Because it's a termination. And it reversed the market. And this is the precursor for the good stuff. And Mark, the small triggers went above, but the large triggers didn't. So, you know what? It has the potential. I have 1, 2, 3, 4 options, Mark, where the market may bounce. I have an enormous amount of risk from the highest point to where my stop has to go. So, Mark, let me tell you what I'm going to do. Mark, I'm going to force a confirmation bar. I'm going to force the market to go in the direction of my trade so that I can reduce risk by 4 points. And because it's only 50-50, I'm going to get paid quick. And if divergence prints on a 50-50, I'm going to GTFO. Morgan, you couldn't have done this any better. You couldn't have done this any better. You knew exactly what you were up against. You knew exactly how much risk was going to go on it. Because you didn't agree with the risk, you forced confirmation so that you could cut it in half. Gold star, Morgan. Does that make sense, everybody? Lonnie, perfect. Lonnie, that is 100% perfect on the gap theory. So much so, I'm stealing it because that is a great picture. There we go. I'm going to give you credit for it too. Oops. Because what happened? Price reached the midband, the 1-to-1s, Fibonacci support. Large triggers didn't follow, and sure enough, it closed the gap right back to them. Does everybody see it? For the brand new user, this says absolutely no shorts. For the experienced user, some of you find a way to go long and close the gap to the triggers, or at least try to. Absolutely perfect, Lonnie. Let's see, who's next? Trying to solidify these in my head a bit more so I may post these without actually taking the trade in an effort to make me recognize them more. All day long, Morgan. Morgan, if you take 2 trades and 20 pictures, you're welcome to post 20 pictures. I want you to know that. We will talk through every chart read, and I'll give you everything that I have. Odds favorable, 50-50. Perfect. First pullback doesn't get there. There's one divergence. So if you get in at the areas, it makes sense, right? 2 ticks from the fib, full reversal, odds favorable, potential to break, 1 divergence. Morgan, is it worth the money? And even if you get confirmation, if you wait for confirmation, init area says to go with the blue fib. No, init area says go from the highest point of support. But Morgan, this is the Paul theory, and I don't think he's in here. Let's take a picture, and I'm going to give you a little annotation. On a 50-50 trade, if divergence prints, but you are still advantage heavy, and want to be in the trade, it is your right to insist the market gives you the least amount of risk entry, or you can choose to not take it, right? And that's one of the things that Paul does. If you guys see him in this room, once that divergence prints, Paul says the only way I'm going to enter is wherever I have the least amount of risk. And I know that that's a potential bounce point, but I'm willing to miss it because the only way I'm going to enter is if I have the least amount of risk. Does that make sense, Morgan? So I agree. It's blue fib or nothing, right? This is your money. This is your investment. They can't force you to enter. We feel like they can, but they can't. They can't make you panic and jump in right here. They can't make you say, oh shit, and get in right here. Only you can do that. You're in 100% control of everything that you do, and I love this. I think you did it really well. Keep posting these. It's a great lesson. Tracy, good to see you posting. Let's see what's going on. Great top, 3 divergences, no triggers cross the fib, not a 50-50, Tracy. Tracy, this is very much directly into a termination condition. Do you see it? There's your divergence line. Look at that. It already stopped the market once. We know it's capable. So you're directly into a termination condition. But let's look at what we have though. You've got some momentum. You're coming from an awesome top. You've got a super low risk entry. Tracy, you're willing to take a shot, right? I'll trade into that blue line because there's more going for me than against me. No divergence, strong triggers. Does that make sense? And because you know that this is a problem, well, you can manage. And you did. You got paid right at the problem. And you said, it looks good, but I'm not going to risk any money. I already got paid. I've got money in the bank. They can get me or not. And let me see. Thought about closing, but didn't when second divergent printed with the smalls inside a large, and you got stopped. Move your stop a couple ticks above the mid band, right in the retracement zone, right? What did it do after? Did it continue down after it stopped you out, Tracy? I don't have ES open. So the likelihood of this second divergence is to take out the previous pivot, which is right where your exit is, right in the retracement zone, right by an area inside of triggers with the rules met for a high probability trend trade. You see it? So this is where you kind of have to make that decision. Am I willing to keep it break even outside of the retracement area? Or maybe I just exit and I'll re-enter if it looks good. But it's a great trade. I like the way you did it. Very, very solid. And I love that this is why you're willing to take a chance. And you didn't hold and hope. You got paid right at that trouble. Tracy, I'm not sure you could have done that one much better. Great work. All right, Better Dad, you're back. I reviewed your first two because I forgot that you had left. So we'll just do it again. Make sure you get it. And man, I hate to praise somebody twice, but I'm going to have to do it because you got some kudos. All right, strong bottom because of that tiny fib. We're going to give it a yes because it was a key number and it stopped right there. I don't know what causes these little itty bitty one bar fibs, but it still stopped the market, didn't it? And it reversed it, strong top, odds favorable, clear path, entered 2 ticks above the mid band, knowing that the market could go all the way down here, right, Better Dad? But with odds favorable and a clear path, you're willing to risk it. And then you just hold for the money. It's absolutely beautiful. You get paid quick, and then you hold for the money. I love it. And the praise that I was giving you is one thing that you've gotten really, really good at is understanding where the market shouldn't go. Whoops. But now I'm going to get you because you're getting a little cocky. You ready? Do you really have odds favorable momentum without separation between the small and the large? No. But do you have a clear path? Yeah, you do. Entered below the 1-to-1. So what kind of trade is this, Better Dad? What kind of trade is this? I just want you to be able to name it so you can manage it. There's your entry, right? And that entry is easy money all the way down. This is the dang it, I really don't have my rules met, but I want to be in a trade. But I love that you get in below the 1-to-1. And I love that you take quick profits. And I love that you don't give anything back. But this look, whoops, without momentum, more likely to give a retracement. Does that make sense? Little impatient. Little impatient. It happens sometimes. Welcome to the hardest thing that you'll ever have to do in trading is work through boredom. Dude, you're killing it. You're killing it. All right, how do I read this mess as far as tops? Triggers got through the one-to-ones, right? Never reversed. It's not even a top. So this, no term, no reversal, it's nothing to me. Does that make sense? Price reaches support, triggers remain above. Just a termination. Well, what do the rules say? The rules say first it has to be a termination condition. It wasn't, right? And then that termination condition has to roll the large triggers. So this isn't a termination condition because the small triggers are through. So who cares about the large triggers at this point? Does that make sense? That dive didn't print on the pivot. Oh, divergence? It doesn't. Divergence doesn't print, better dad, until right there. Middle of the third bar. Or middle of the second bar. That's when the calculation is done. That's why we say when it's just one divergence, price didn't reach divergence. Price at a loss of momentum creates the divergence. Divergence is only a termination when price comes back and reaches it and the triggers don't break. Does that make sense, everybody? This divergence wasn't true until here. This divergence wasn't true, printed, until here. It's the retest. Perfect. So we end up here with a termination condition. The large triggers never even roll from up to down. They just stay up. This is second level. Strong tops and bottoms, better dad. Because the triggers never even got to roll against it. I'll call this a strong bottom all day long. But remember, and guys, when I teach this room in the morning, I teach this room based on the most basic approach for the newest of new users. So for the brand new user, a strong top or bottom first must be a termination, and then it reverses the market. As you grow a little bit, you'll realize that if you have a termination and the large triggers just stayed up, that's a powerful, powerful strong bottom. Does that make sense, better dad? I love this picture. This is great lessons. I would call this a strong bottom all day long. And it was full of kickassery right until price reached Fibonacci resistance. None of the triggers broke. So once again, termination, right? And then the large triggers rolled. And now my termination is a strong top, 100%. Does that make sense? And then better dad, that strong top gets you all the way to the next termination condition. Just a termination, nothing rolls. This is the exact same, there's no roll. It's just, don't go short into it. This might happen. And then it comes up, and check this out. That's your third divergence in the same price range. That's a termination condition, isn't it, everybody? 3 divergences in the same price range. Did any trigger lines get above that divergence? They just kept angling down. The same way, they just kept going up. I would say that is a super strong indication. So I have a strong top that bounces and creates a second strong top. And better dad, with all that strength above, whoops, that may be why you were so okay with taking this shot. Does that make sense? Does that clear up all the reads? And it goes back to, and I know I'm a broken record, guys, language pays dividends as you learn the software. What's a strong trigger? Separation between the small and large, open scissors. What's a termination condition? Price reaches an area, triggers don't break. What's a strong top? That termination reverses. And if you learn the basic language, what happens is you don't ever guess, right? You keep it pretty black and white. You keep it pretty, man, it is if then, 100%. If this is what it's doing, then that is what it means to me. Lonnie, you said that I just said this. What did I say about it? I don't remember. I say a lot of things. Yeah, so Lonnie, odds favorable. We're losing momentum. 3 divergences in the same price range. This was your entry back here, Lonnie. So the one that I pointed out was odds favorable, potential to break. That was it right there. Opportunity to make money up to trouble. Does that make sense, everybody? Lonnie, when we discussed this one on the live charts, we talked about this was your entry, and it gave you time to manage. This is a little later in the move, directly into the termination conditions. Big difference between the two, right? One of them has the potential to break, room to targets. One of us has already reached all the trouble, and we're losing momentum. And you can see it through the divergences. I hope that makes sense, everybody. No worries. Take care, Alex. And then I'm going to open this up real quick. I don't know why, but I have to put it over here. I want to go back to the 3 divergences, Better Dad. Because from the instructions here, I've got a picture. So 3 divergences may terminate the trend. 3 divergences with weak triggers is more likely to terminate the trend. 3 divergences with that head and shoulders pattern that you referenced is even more likely to terminate the trend. So Better Dad, when you're looking at 3 divergences, head and shoulder, everything down, that's where you start going, I have everything on God's green earth saying this market has stopped, a top is in, and they're going the other direction. Maybe I'll take a shot. That's how trading plans evolve. Good stuff. You guys are amazing with your pictures and your questions. Let's see. Better Dad, did we get this one? Yeah, we did, and we laughed. We laughed. Bob B. the man. Let's see what you did, Bob B. the man. Warning, not a Nexgen recommended trade. Nexgen doesn't recommend trades ever, guys. Ever. Academic knowing versus implementation. Well, that's it, right? You could read 1,000,000 books on how to fix a car. But until you're elbow deep in the grease and having to do it, it's just book smarts, guys. It's the difference between street smarts and book smarts. You're getting your street smarts right now. You'd call Wayne. That would be a good move. Strong top, not a clear path. Mid-band is a term. You take a shot into the termination because of the strong top. And you manage it aggressive as all get out. So, Bob B. the man. I want to make sure that I have this right. So correct me if I make a mistake. Because of the strong top, I know that the market has a shot at really changing direction and going the other way. There were huge impactful decisions made right at a key Fibonacci area that gave me odds favorable momentum. Sounds so far so good? And even though there's a termination condition there, I took the time to weigh out what my small chart was telling me. And my small chart told me that I had odds favorable momentum is there as well. Which means momentum's hard to stop. And sometimes there's a retest bounce. And I knew then an area inside of triggers is a great place for that bounce. So because of my strong top, because of both charts with momentum, because of absolutely no divergence, I'm willing to take a shot at this one, knowing full well that it could go close the gap back to those triggers. And because of that knowledge, probably had a pretty tight stop. If it doesn't go, I won't stay in it. And when it starts to go, I'm going to make some freaking money and get out because my pattern says that it's more likely to do that. Does that sound about right? That's a chart read. That's taking your ability to read charts, to understand advantages, to recognize patterns, to realizing that it's not perfect, managing aggressively. Guys, this is what happens. This is your next level. But Mark, it was a termination condition. But yeah, let's look at everything great, right? I love it, Bob. It shows that you know what you're up against. And when you know what you're up against, you can manage instead of hope. That's my hope for every one of you. Good job. Nice recovery. I was still a little mad about the annotation mistakes earlier, so I guess we can be friends again. It's a quick hit, right? Love it. All right, Joel. Odds favorable, no clear path, coming from a strong bottom, no divergence, perfect entry, money to be made. Other Joel. I got two of you now. Sorry, Joel's going under Joe. Does that make sense though? Look at that. That's everything. And he verified it with a checklist to make sure he was optimizing his chances of success. So I got red Joe and gray Joel. So Joe, do me a favor. Tell me you're good at this. Because it sure looks like you are. Lonnie. All right, Lonnie. Why? Hold on. I think it was going up. Help me out, Lonnie. Did you have strong triggers? What do you think? Amen, Bob. Guys, I don't have a filter. I'll warn you right now. But 20 years of managing restaurants, I can say the meanest stuff in the nicest way. Why didn't you write it? Did you have a clear path? Why are you making me annotate your charts? I know how to read these. Did you have a pullback to an area inside of triggers? So, what are you going to do with that picture? Where does that picture go? If you're a betting man, it goes into your trading plan because it's perfect. But what did you want to hear from me? And Lonnie, I'm not beating you up. This is for everybody. Why? Why? Write the whys. What are the whys? Tell me the whys. Guys, I know exactly. I know exactly what happened there. But you didn't tell me anything to confirm, Lonnie. Where did your stop go? Where did you take profits? So if you need confirmation, I had this. Am I reading it correctly? Do me that favor, because this is your recipe for success. Learn it, commit to it. You shouldn't need confirmation if you write this. Does that make sense? You don't need me to approve this trade. You did it with this. It's a pattern that wins more than it loses. There's nothing to confirm. I love the trade, Lonnie. I'm telling you guys, I promise you from the bottom of my heart, this is how we do it. You expect it to hit the next term fib. Why? You entered at a fib or midband, hopefully inside of triggers. You got out at trouble. And you could have entered again. I agree 100%. Why? How about momentum? So again, we're writing the recipe. Strong bottom, odds favorable, potential to break, entry at an area inside of triggers, exit at trouble, second chance, momentum trade, carry it to the next level. Absolutely gorgeous, Lonnie. But if you don't write the recipes, how are you going to repeat it? Should have entered the trade again. Why? Does that make sense? Am I becoming a pain in your ass? I don't mean to. I promise I don't. I want you to be able to repeat the success every day. I want you to be like, man, I know exactly what it takes to get me in a trade. I know when my advantages are there. Oh, I'm telling you, that's how you get there. I say there's no way in hell I enter this trade again. Why? Because I've got two divergences on a 50-50. That's a rough look. That's a look that actually loses more than it wins. But because you have the hindsight of seeing it go up, you say, well, golly, I should have entered that trade. But what happens is that is two divergences on a 50-50. That's a tough look. That's a look that areas don't always fulfill their potential to break. Like that first one, though. Like that first one. Love this recognition of the gap theory. I think I stole that one. All right, Joel. Strong momentum, trigger spread, room to the target. You take a pullback to resistance. Did it make it to the midband? Joel? Guys, I love you're in the middle of it. It did, right on. Momentum. Did you notice one fib, two fibs not broken? Cool. Was your stop where the market shouldn't go? It wasn't. Well, it was right at a fib. That's a rough stop. Because it could have gone up there, but that was probably as much as you were willing to risk. That's an arbitrary 12 ticks, right? Was that your ATM strategy? But my ATM strategy says 12 ticks. That's pretty common. Remember, stops go where the market shouldn't until you get confirmation that it's going in the direction. This second higher divergence is dangerous. With the ticks, okay. We'll go through and do that. But then it confirms again and goes down. It's a nice trade. Utilizing momentum. So let's go to the live market real quick. That's crude oil going slow. Let me get this big enough for ticks. Dun, 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 dun. Take a picture real quick. All right, so guys, we're going to use our imagination a little bit. This is the highest point of the triggers. Whoops, wrong one. From the highest point of the triggers to the lowest point of the triggers. Is everybody comfortable with that? That goes from, we'll call it 91 to 96. This is where the market is most likely to retrace if there's a pullback. Everybody's good with that, right? And this is crude oil. So crude oil from 90 to 80 is 10 ticks. Each tick in crude oil is worth $10. This is the smallest increment of price that crude oil moves, is a 1 tick. Everybody with me so far? So if the rules say 4 to 5 ticks, there's your first tick, there's your second tick, there's your third tick, there's your fourth tick. My stop belongs right there, 4 ticks below. So that's the math that you're going to do. And the cool thing is even if it is another market, this is YM. I don't know what YM moves in. It looks like, well, that's a large chart. Let's break it down to a small chart. YM goes 70, 71, 72. So it looks like the YM is the same. It's 10 ticks per move. So if all of the rules are met, and the top of the triggers is 74, 78 is my 4 ticks. There is where the market should not go in a rules-based trade. So take your top line number and then be able to see the tick is 5. See, but it has nothing to do with price, Better Dad, right? All we're saying is that I want to give it a little bit of wiggle room. That's it. But a tick has nothing to do with money. A tick has nothing to do with price. A tick has nothing to do, well, maybe it has something to do with price. A tick has nothing to do with winning, losing monetary. So in crude oil, and it's just every market. In crude oil, it goes in tenths. So each point is broken into 10 ticks. In the S&P, each point is broken into 4 ticks. But it doesn't change that it's 4 ticks. A tick is the smallest movement that a market offers. So we want to put our stops 4 of the smallest increments below. Bottom of the triggers is at 97. It would be a 92 stop. As the triggers go up, so does the potential stop. Does that help a little bit, Joel? Does that make sense, everybody? Has nothing to do with money. We could pretend like this trades in chickens, right? Each tick is a chicken. Who cares? It's a goat. 10 chickens makes a goat, right? 4 goats gets you a wife. I don't know. But I'm 4 chickens below the triggers. I just made that up. That's hopefully not offensive. Love it. These are the things that I don't think to talk about, like a tick. What's a tick? It's just the smallest movement that the market can make. That's all. 6 Super Bowls makes a goat. Hey, there you go, Jeffrey. I like it. I like it. All right, guys, I'm going to go run a lap. I'm going to take a break. This is crude oil. Feel free to watch it. When I come back, it's your room, guys. I don't know. All I had to do was step on a duck. I got the perfect wife, so. Actually, she stepped on a duck. If you know the joke, it's funny. If you don't, no big deal. I'll be back in about 4 or 5 minutes. When I come back, it's your classroom, guys. Let's talk about everything that you want to talk about. So I will see you in about 5. Talk amongst yourselves. Post them if you got them. All right, y'all, let's finish strong today. You have to get Discord on your laptop? Right on. We'll be here. Good to have you in here, though, Cav. Boaz, let's see what you did, my friend. Odds favorable. Great bottom. One-to-ones could be an issue. I love it. Potential to break, but not broken yet. So you wait for the confirmation. Instead of getting in because of divergence, you say, you know what? I'll force the market to go in the direction of my trade, and I'll get paid at trouble. And Boaz, consistent. You are like a clock, my friend. Everything that you do looks the same. It's all starts with momentum. You're always looking at where the market comes from. You recognize that it's the potential. I love that. And you say, if it's not perfect, let me force the market to confirm it. I've still got room to my target. Great trade, Boaz. There's that YM into a termination condition. That could have been an opportunity though, right? Maybe? Maybe a short there. Make a little money. Potential to break. Clear path. I mean, come on. So, who's trading the YM now? Guys, report back to us. When you check the YM and you're looking at it, let me know if it's temperamental, if it overruns. Learn the temperament of the market. I think that's important. Because a lot of times, yeah, it's different. Like, if you spent a month trading the S&P and then you traded gold, you would probably get run over a lot because gold tends to overrun areas. But if you know that it tends to overrun areas, you start incorporating confirmation bars. You start doing things to cater to the mentality of that particular market. And I think it's pretty cool when you do that. Switching to the NASDAQ, I tried to use an S&P ATM strategy. I got slaughtered. And then on the NASDAQ, fighting the small triggers on the entry chart, I got slaughtered. I had to learn the personality of it. And once you do, it makes it easier. Right now we have the potential to break, but we have two divergences. We're coming from a great bottom. The momentum is solid. The potential is there. This is the RTY. Some people say, I'll just go no matter what, all willy-nilly. Some people say, I'll force them to confirm. Some people say, well, I'll get in if they break above the half bar, right? Everyone's got a different plan. Me personally, two divergences on a 50-50, I just don't care for it. There's too much that happens in the market every day. There's too many opportunities all the time for me to take the I hope trades, the I wish trades, the man, I know that this sucks, but I really want to be in a trade. Let me get in anyway trades. We're going to start showing some pictures. This is one of my favorites, the experience versus time. Everybody gets software and it looks like fun, right? And you start saying things. I'm going to be rich next week. I'm going to make $10,000 a day. I'm going to buy a Ferrari on Tuesday and a mansion on Wednesday. And I'm going to supersize. And I'm going to do that at least by Thursday, guys. And then Mark shows up and he says, hey guys, here's your path. Take some pictures. Here's your path. Post in the room. Hey guys, here's your path. And you're like, well, I'm getting lucky. Cav. I'm getting lucky and I'm not sure what I'm doing, but I know that it works. I keep seeing people in this room posting these winning trades. I keep seeing people in this room. Hell, I saw this guy that was in London do the same thing as this girl in North Carolina who took the exact same trade as this kid over in LA. And it's just a pattern and they learned it and they're doing it. I probably know it too because I got lucky on Sim. I made $1,000 yesterday. Have no idea how, but I made it. I'm going live. I'm gonna go live. And guys, this is my autobiography, true story. And I went live 30 days. 30 days into having the software. I was still on painkillers from a double spine fusion. And I lost $5,000 in 21 trades, 2 hours. And I'm telling you guys this because I didn't know why I took any of those trades. I didn't know why I should have exited any of those trades. I didn't know what my pattern looked like. And everything that John Novak told me to do, learning this software, I refused to do. I didn't annotate charts. I didn't ask for help. I didn't use the spreadsheet. I wasn't participating in class. And guys, I got blown out of the freaking water. And it wasn't a prop firm $5,000. It was my own $5,000. And I took a tumble, Jack and Jilled it all the way down to the I don't know shit stage. And I was dejected, and I was feeling beat up, and I was mad at my brother for even suggesting that I could do this. And it was right here. Guys, it was right here where I had to make a decision. I either had to quit because I'm too smart to follow a recipe, or I had to eat a little crow, to suck it up and say, all right, he told me that if I take pictures and annotate them and post them in the room, he'll critique every one of them. If I have a written plan, I know exactly what I'm supposed to do. If I take pictures of what it looks like to have that plan met, I understand my patterns. And guys, at that I don't know anything stage, this is where everybody makes a decision. You can bypass this horrible tumble down if you just move that stage over here. And this classroom is designed to keep you from destroying your money before you start to follow the path. And that's why, Lonnie, I'm a pain in your ass about annotation, right? Bob, that's why I pick on you about writing the right thing. Morgan, that's why I tell you every picture belongs in this room. Because it does start to make sense. And you do start to surprise yourself at how good you are. And eventually you did it, guys. And just because you did it doesn't mean you won't make mistakes. But it means you're going to recognize them and you're going to work to fix them. So I love this picture, but this is very much my journey, guys. And the funny thing is I started teaching people the path about right here. Before I was even great at it, I was so convinced that the path was right because I started the study taking the pictures. I was 500 pictures in and I was like, oh my gosh, this is everything John Novak told me that it was going to be. John, let me go teach people how to do this. And he did. He gave me a job. Pretty cool. All right, Morgan, what'd you do? Some of you have been around for the duration too. You've seen me go from the afternoon classes to this one. All right, strong bottom, odds favorable, one divergence doesn't matter. Why would you wait for the confirmation, Morgan? Because it lost? Let's be clear. Should you have waited for confirmation because the trade lost? Or because there was a reason to wait for confirmation? Hold on. Odds favorable momentum. Yes. Let's just take a look on that bar that you entered on. Large triggers are above the area. Morgan, you have a clear path, 100%. 100% you have a clear path. Hold on, let's do the math. Whoops. Yeah, get off of there. Did you have areas inside of triggers? Yes. So you're telling me, I'm gonna put my Morgan voice on. I don't really know what you sound like. You got to sound better than me. I have a pattern with rules met 100% that has been proven to win more than it loses. And because it was a loser, I figured I need to change the plan because this one trade is indicative, let's use a good word, indicative of what is to come. Sound about right? Because this trade lost, from now on, every time I see divergence, I'm going to wait for confirmation. Because this trade lost, I'm going to say that mid-band might have been a problem. Because this trade lost, I should have waited for a lower spot here and only had 2 ticks of risk. I should have put my stop behind here. I shoulda. That's your pattern. You did it perfect. I mean, you did it perfect, Morgan. The only challenge is that there was some jerk-faced sellers that wanted to push lower. That's it. Does that make sense? And Morgan knows I'm going to use everybody's pictures to teach lessons for everybody, not just for Morgan. I love this look. I would take this trade and lose it with you 1,000 out of 1,000 times because it fits my rules. Because when I have a strong bottom and odds favorable momentum and everything is screaming up, life is good, Morgan. Love everything about it. Nice trade. All right, Joel. Strong triggers, clear path, room to target, perfect entry, run the fudge over. Guys, just because you take her to dinner and buy her flowers, she's not obligated to kiss you at the doorstep. Joel, perfect trade. Would you take it again if it's set up the exact same way, guys? That's the question. Or would you change your plan because this one didn't work? Because one trade didn't work? So let's see. I don't have the ES open. Let me open the ES real quick. Post your pictures, guys. Let's see them. Let's see what you did. Better dad. Odds favorable. Clear path on trade 1. Perfect entry. Easy money. Trade 2 is directly into a termination condition. Got lucky. Profit target 1. Break even. Because momentum is hard to stop. Better dad, you remember on your first day when I said when we talk about odds favorable momentum, it'll cover mistakes sometimes for us? You traded directly into a termination condition. That level of momentum got you back to the retest. That's heads up trading. I'm not going to beat you up for it because you knew it wasn't perfect. You chose to take it anyway, but you didn't hope for the home run. You said, man, things are changing. Nicely done. Worth the risk. That's all you can ask for, right? Seller said no, straight to support. Buyer said, dude, we want to go up. Bad top. Here's the odds favorable. Here's the clear path. Here's the perfect entry. And Morgan, they gave it back to you. You bad mother sucker. So Morgan, what's the difference? No divergence? But look at this. Your synthetics aren't even up yet. Which is more detrimental? No momentum on the large chart or divergence on the small chart? I don't know. Great trade, Morgan. Opinions suck, don't they? Guys, my opinions are wrong so often. I hate to admit that to a live room. My opinions are so wrong. But guys, remember, it's not the 1 or 2 times things don't work out. It's the 7 or 8 that it does. Termination conditions. It's not the one time it breaks, it's the 10 time that it doesn't. Having an advantage. Morgan, this is gorgeous. And Morgan said, I'm not even going to wait for confirmation. This is perfect. Everything about this is perfect. Caught it on the way up. All right, Joel, I need to see yours. Morgan showed his. Oops. I don't even have any indicators on mine. Did anyone else catch that one? Here's the question, Morgan. Did you make more on this trade than you lost on the other trade? $07.02, so 5 points, 3, 8 points, $50. Every point is 50. So that was a $400 trade, right? And this one, I can't read your numbers. 99. Did they slip you on the exit? Because you're at 70.50 at the bottom, which means 99.50. It looks like you gave up an extra 3 ticks. They might have slipped you a little bit, though. And that's day trading, guys. You had a fib where Morgan didn't? Right on. I mean, that's day trading. You win some, you lose some. It's a cha-cha. Yeah, you had a fib in the way, huh? Well, better dad, man, I'm not supposed to admit this. I like you more than I like Morgan, so I gave you some extra fibs in there. But that same fib kept you out of the loser. There's different reasons. Sometimes it could be that you're in a different time zone, but you guys appear to be in the same. Every morning, better dad, I go through and I clean out tick data. I clean out my cache. I get rid of my temporary folders. Every morning I go through the NinjaTrader best practices. Whoops, that was the wrong one. So every morning I go through the NinjaTrader best practices. And if you don't do that, you might have one piece of corrupt data. There may be something different. And remember that fibs come to be from... Where's my picture? I can't find the picture I wanted. Fibs show up from tens of thousands of calculations. So if there's a little piece of corrupt data, if one pivot is a tick higher, tick lower, something like that, it's butterfly effect. It makes the whole matrix go crazy. Sometimes, so there's my ES. Mine looks a lot like Morgan's. Sometimes if you haven't cleaned out, if you have something corrupt in the workspace, there's reasons, different time frames, days back can have something to do with it. So better dad, if you right click and go to data series, how many days back are you? If you're 9 and he's 10, it's totally different fibs. If you're 11, if you're 8, if you're 5, if you're 30, if those numbers are different, it makes a difference. If Morgan doesn't have tick replay clicked into, looks like he does. Who knows? But I always say trade your charts. I know that's not a very precise answer, is it? Trade your charts. And if your charts are a concern to where they're creating a confidence issue, I do this at least once a week. Yeah, and that's it. I do this once a week. Once a week, I give my system an enema. Once a week, I get rid of all of the old templates. I get rid of all the old workspaces. I reset... where is it at? I reset my data. I repair all my data. Where did that go? There it is. So I do that first one, and I do this one, and I do this once a week because I spend so much time messing with my charts and going back and forth and building different time frames and looking at different patterns and all that. So like even if you've got like a hint of lack of confidence because you're like, mine doesn't look like his, go back and do all this, and what happens is you know that you're fresh, you know that you're good. And we know that it's Morgan's fault. Oh, I don't give advice, Better Dad. All right, Joel, thank you for putting this one. There is no gap theory. Large triggers aren't a full bar away. It's not into a termination condition. Remember, divergence is created. This is where divergence is reached. So for a termination condition, price has to reach it. Price made that one. You had odds favorable momentum. You had a clear path. You had the perfect entry. It just ran you over a little bit. And I don't know why you held that one so long. The part that's concerning on this one is that you held $250 worth of risk below the triggers. This should have been a $50 loser. Wait for the next trade. That's huge. It's a perfect look over here. It's a perfect look over here. Those sons of guns just didn't give it to you. But you held on. And Joel, this isn't just for you. This is for everybody. Guys, the reason this concerns me, it doesn't even concern me. But if you're in at 87 and your stop belongs at 82, but you say, oh, I'll put it below the fibs because the fibs are safe. I'll put $500 worth of risk on it. I'll hold through everything changing. What you're doing is you're creating bad habits. You're doing things that are creating an element of luck rather than a recipe for a pattern that is repeatable. Now, if you need to give it an extra tick or two, that's one thing. Giving it an extra $100 worth of risk per contract, that's luck that tends to run out when you go live. S&P looks like it's been doing great things most of the day. Beyond the triggers, where the market shouldn't go. That's the beauty of it, Joel, is you're so good at this, you know where the market shouldn't go. You know where your advantage is gone. And let me say, Joel, if you had, let me do this. So let's say hypothetically, there's your area, right? And you had a yellow 1-to-1 right here, and you're like, you know what? Normally it's 4 to 5 ticks below, but I've got this yellow 1-to-1 and the rules are perfect. Maybe I'll put my stop 7 or 8, right? I'll give it a couple ticks, a little bit of wiggle room, but then that's a decision made on an area, on something bouncy in the way. Maybe I've got fibs on both charts right here, and I'm like, I'm willing to risk a little more because I've got so many reasons this market is going up. That's kind of that it makes sense approach. It's a great look, though. Great look on the large chart. Perfect entry. Perfect entry. Morgan's is still going, isn't it? How many divergences does it take to get you out of a high probability trend trade before profits are hit? Does anyone remember? It's 3, right? We still haven't gotten it, have we? You still haven't gotten 3 divergences. And look where it's at. Right at Fibonacci resistance. Pretty cool. Who got scared out with all of this? Hold on. Right back to the mid-band in the retracement zone twice. Never went where the market shouldn't go. All that momentum, right to your target. That's where you're headed, guys. If you got in and made $300, awesome. If you got in and made another $300, awesome. If you got in and made another $300, awesome. It's subtle differences that are going to be the difference between a good day and a great day, right? It's going to be management. It's going to be understanding why you're going to exit, why you're going to enter. But it's trust. It's trust in the software, guys. That's what makes it where this doesn't freak you out. And even if you exited with the lower divergence, the confirmation bar was your reentry. And it keeps going. Like it. What else, y'all? What do we want to talk about? Look at that. It made it to the fib. Nice trade, everybody. Welcome to Nexgen. Odds favorable, clear path. Did the momentum ever go away on the large chart? Let's talk about that. Did the momentum ever go away on the large chart? Nope. Did the path ever not be clear on the large chart? Nope. And sure enough, off it went. Pretty neat. Well, there's the same darn look. Odds favorable, clear path, pulled back to support inside the triggers. You are already up $100 and break even. This is the RTY. Strong bottom, full reversal, odds favorable, didn't hit it, pull back to support, easy $100, now you're break even. Do you guys see it? Ladies and gentlemen, the market has a memory. The market has a memory. Oh, not again. Odds favorable, clear path, pulled back to support inside of triggers. This is the YM. Come on, guys. Somebody's messing with my stuff. There is no way that this is a pattern that repeats itself on every market. There is no way that all you have to learn is how to trust that, because the market does that more often than not. Better Dad, did you get this one? You're my YM trader. I mean, great googly moogly. I hope you were pooping or something then, because that was perfect. I hope you didn't talk yourself out of it. And that's not true. I don't think I've ever hoped for another man to poop. But does everybody see it? Even if you didn't take the trade, would it be okay to go through that process? Odds favorable momentum, clear path, pull back to an area inside of triggers. This is the description of a pattern that has been proven to win more than it loses. That's it. I suppose we should put this one in the plan. Never miss. No worries, Fibs and John. Do the rebuild. See how it works for you. It may not change a thing. But guys, that's your pattern, isn't it? Steal that picture. I annotated it for you. And termination condition. No areas inside of triggers. Where was the entry? Mark, the market went up. It went up 40 points or 40 ticks. Where was the entry? Do you guys see it? Do you see where your rules were met there? It's a trick question. They weren't. That's not your money. That's not a pattern. That's the market running away without you, and you have to be okay with it. That's hard to swallow sometimes. But if you caught that one, you don't care. If you caught that one, you don't care. If you caught that one, you don't care. Golly. I couldn't handpick these for a class any better. I didn't have to. They happened live right in front of you. Every one of them. Every one of them. In the Dow, terminations work on crude oil. High probability trend trades work on the ES. The RTY is not afraid. We're going to start doing this. We're going to start doing hogs and feeder cattle and just changing markets. Gosh, I feel like I should drop the microphone and get the hell out of here. Because that's everything you learned in the first hour. Everything the market just did in the last 5 minutes is everything that you learned in the first hour. And if you stay focused, if you simply say, my rules are met, I'm going to take that trade. A lot of success to be had. What a great day today, guys. I appreciate you. Really do. I appreciate all the charts, the questions, the tolerance of me turning your charts into lessons. I know that's a pain in the butt sometimes, and it's not always fun. But I promise you guys, everything that I do in this room, I do to help you get better. I do to get you focused on advantages. I do to make you a chart reader. So once you're a chart reader, things are great. So, final reminder, and then we're going to call it. Today is FOMC day. If you are saying to yourself, I know it's crazy volatile, but I have to trade, I can't not trade, that's on you. I've played with it on simulator. I've lost like 7-8 grand on simulator trying to time out the spikes. So, guys, just know it's coming. 1 p.m. Central, 2 p.m. Eastern. You got 2 hours until the market goes apeshit. If you've never seen it, have fun with it.